Hey, it's Richard. We're going to do the asset class performance. This is actually take 3 because of microphone issues, but hopefully this can be a quick video because I know exactly what I'm going to say. So let's just jump right in and talk through some indices. The NASDAQ, mainly large cap growth and tech stuff, up 12% for the year. You can see the big dip that happened in the March-April timeframe. That is the war, and then the lack of concern for the war as inflation takes over, the 10-year yield goes up, and nobody cares. It's just keep buying, right? That's the way our economy works until it doesn't. But 12% Nasdaq. Then we jump back to the S&P, and S&P is only 8.4. So that's more of an average, but it's also a skewed average. We have such high concentration and a lot of returns in the market, and then you look at the rest of the market is kind of flat, not doing much, but the index looks fine, so nobody's concerned. And that's a core theme here. Corey Jenkinson is on board now, helping with some investment research, analytics, and helping with the portfolio strategy that we're doing here. And so we're speeding along to try to get some things trimmed. We've made quite a bit of money, but the idea is that there's so much concentration at the top and the numbers are so ridiculous. We really want to get some changes made. So I'm not going to get too in depth with the actual holdings, but I want you to understand the asset class performance behind it. And after we've made all of these trades, we're going to do a separate video where we discuss individual decision making and why we were doing what we were doing. But let's keep this one pretty brief. So 12% NASDAQ, 8.4 S&P, and the moderate 50-50 is 8.6. That's kind of odd, right? Because now we've thrown 50% bonds into the mix. So how did we go up? How is it that a 50% bond allocation increases our return above the S&P 500 as a total risk portfolio? Strange, not normal. We don't see it very often. Same shape and everything, but it has something to do with the individual asset classes of stocks. So I'll try to go through this quicker than I did the last recording without a good microphone. And there's a good theme here. If you look at the top line or the top number in each box, that's going to be the last 6 months or roughly year to date. And then the bottom one is the rolling 12 months. So just think 6 months, 12 months. So 16.4 and 30. That's about halfway there, right? Yay, duh. Core 10 and 25. Okay, it's slowing down, but still roughly half. Growth, something major different there. We've only got 4.5 versus 21. So most of its gains were before this year in the AI and tech world. So pay attention to that. Mid cap 16.28, still kind of the half feel to it. Core, still kind of the half feel to it. And then growth, it's only up 5.5% in a year, of which 4 is in the last 6 months. Oh, it's picking up, but man, it's really lagging the other asset classes there in stocks. Small cap stocks, 2042, 1940, 1837, great. But man, look at those numbers. 42, 40, 37, huge returns in small caps. So while everybody wants to buy Broadcom and Nvidia and Microsoft and Meta and all of the AI is going to solve all of our problems for us, there's some real returns happening in the smaller companies as they start to capitalize here. So that's something to pay attention to. That's something that kind of spurred, hey, Corey's here. Let's get to making these decisions on what our gains are we want to sell and where our opportunities actually lie. And so we'll be making a bunch of changes to this portfolio. We're probably, I don't know, a third through the stock allocation on how we want to make changes. Trying to hurry up and get that done before the end of June, and it's the 19th today for reference. So international, kind of same theme, 1022 and 2751, but man, 51%. Now, why are we up 20 and 40% and 50% in our stocks? Well, I almost said all of you, but y'all work with the firm here, but the majority of the investment public, they just put money in their 401k and never look at it, and everybody's buying the exact same stuff, and not a single person is paying attention. Even you go to a broker, you go to your Edward Jones, Merrill Lynch, Raymond James, whoever, when they sell you a mutual fund, it doesn't matter how it performs. They get their 5% commission and move on in life, right? So like nobody cares enough to say, should we be buying into this right now? No, it's just everybody's making money, and that's when I get fearful, right? And that's why we are working hard to get these reallocations done. Bonds are exactly what they're supposed to be. This is awesome. So 3, 4, 5, 5, 6. Yep, that's what we would expect. That also gives you a lot of insight as to how the moderate portfolio is outperforming the S&P 500 using a mixture of these small returns here. Big red flag. So lastly, my favorite, commodities. I made an error. I've admitted it 3 times now on these microphone troubleshooting issues, but 66 and 46 should be green because it's just way up, right? That's 67% increase in oil. Now we are heavy in oil, gold, and silver, as everybody knows, so we rode that up. We're looking to trim some back, but we're not going to just assume, oh, it's time to sell. As a matter of fact, it was down to 73 this week, and I expect will probably be $80 oil for quite a while. So we got a little rebound there, but yeah, that's what happens when you shut off, I guess, the Strait of Hormuz, which we don't really use, but we were capitalizing by selling our oil internationally for some really good premium. The U.S., you know, and its whole tariff and strategy against the world, I guess that's a big win or something. But you know, overall input costs went up. Expect to see CPI and PCI and PPI and all this stuff to just continue to go up. Yes, inflation. Yes, the 10-year yield will stay elevated, but hopefully it can kind of come down. Gold, we sold, perfect timing, best call of my entire career. I'll never be that good again. Literally, we sold it the day before the crash, and it's been sitting in money market for all of you that are in the IRAs there. So yes, we've also outperformed gold since then, which is cool. But yeah, expect it to continue to go up just a little bit more slowly. Real estate is recovering. 12 of its 13% rate of return has come in the last 6 months. So that is a good start, I guess, to this year. If we can get the 10-year to come down, which really comes from money printing and expectations on inflation from energy and input costs going up. But if we can get that 10-year and expectations of inflation to drop, we'll see more deals done in real estate because then the mortgage rates will actually drop. And I'm looking to build a house, so I really do want those mortgage rates to drop. Bitcoin, I am not going to kick a dead horse. Well, wait, you don't kick horses. That's not good in general, but it has nothing to do with horses. Bitcoin taking a big backseat, down 40% in the last year, down 25 year to date. What is Bitcoin? I guess it's a currency, so I'm not against it. It can certainly be a part of either a hedge, good luck figuring out the correlation, or it can be part of a cash reserve and like how do we fight against inflation potentially. But man, what a wild swing that we've seen in Bitcoin over the years. But that's it. Those are all the asset classes that I wanted to cover. Like I said, I'm not going to dive into the individual performance of our holdings because that is what Corey and I are working to get done. Hopefully by the end of next week, we can start working through the iRebow part of Schwab to get ready to place a bunch of trades again, especially in the qualified accounts. But this should be a good overview where we are for the year. Again, trying to get this newsletter out before the end of June, and we will do another video about our reallocation changes, but quite a big year that's not so boring and cause for concern, but trying to keep this under 9 minutes, so I've done it, and see you next time.